If you drive for Uber, Lyft, DoorDash, or Instacart, the IRS treats you completely differently than a regular employee. And that one difference is why so many drivers get a shock bill in April. This is the complete 2026 tax guide for gig drivers. What you owe, what you can write off, and how to stop overpaying. Let's break it down. Here's the core thing to understand. When you drive for an app, you are not their employee. In the eyes of the IRS, you're a self-employed business owner, an independent contractor. No taxes are taken out of your payouts. That means the responsibility to calculate and pay your taxes falls entirely on you. And because you're self-employed, you actually owe two separate taxes. The first is regular federal income tax, same as everyone. But the second is the one that catches drivers off guard, self-employment tax. Let's talk about that one, because it's usually the bigger shock. Self-employment tax is 15.3% of your profit. That's 12.4% for Social Security, plus 2.9% for Medicare. When you have a normal job, your employer quietly pays half of this for you. As your own boss, you pay both halves. On $10,000 of profit, that's about $1,400, before any income tax at all. The Social Security part applies to your first $184,500 of net earnings in 2026. The Medicare part has no cap at all. For almost every driver, the takeaway is simple. Budget for that 15.3% on top of your income tax, because no one is withholding it for you. Now, what forms will you actually get? Two main ones. A 1099 NEC, which the platform sends for your driving pay, and a 1099K, which payment processors send for transactions they handle. These report your income to you and to the IRS at the same time. But here's the mistake that costs drivers the most. For 2026, the reporting thresholds went up. A 1099 NEC is only required once you hit $2,000, and a 1099K only if you clear $20,000 and more than 200 transactions. So many drivers won't get a form at all, and they wrongly assume that means the income isn't taxable. Let me say that clearly, because it's the most expensive misunderstanding in the gig economy. You owe tax on every dollar of profit you make, whether or not a single form ever arrives in your mailbox. The forms changed. The rule did not. So where does it all go? On a form called Schedule C, Profit or Loss from Business. You list everything you earned, subtract your business expenses, and what's left is your net profit. That profit is the number both of your taxes are based on, which means the lower you can legally make it, the less you pay. And here it is. This is the real Schedule C from the IRS line 31. Net profit or loss is the number that flows into the rest of your return and gets taxed. Everything we do next is about making that line as low as the law honestly allows. Here's the good news, and it's big. Every legitimate business expense you deduct lowers your profit, which lowers both your income tax and your self-employment tax at the same time. So for a driver, deductions are worth even more than they are for a regular employee. Let's go through the ones that matter. The single biggest deduction for almost every driver is your mileage. For 2026, the IRS lets you deduct 72.5 cents for every business mile you drive. Drive 18,000 business miles in a year, completely normal for a full-timer, and that's a $13,000 deduction by itself. But you have to know which miles count, and it's more than drivers think. The miles with a passenger or delivery, the miles driving to a pickup, and the miles driving to a busy zone to wait for requests all count. Your commute from home and personal errands don't. And the catch, you need a mileage log. Guessing at tax time gets the whole deduction thrown out in an audit. Mileage isn't the only write-off. The business use share of your phone and data plan counts. So do tolls and parking, insulated hot bags and delivery gear, dash cams, and any supplies you buy for the work. And if you pay for your own health insurance, self-employed people can often deduct those premiums too. These add up fast. Two more deductions almost everyone forgets. First, you get to deduct half of your self-employment tax. The IRS lets you write off the employer half. And second, the qualified business income deduction can knock another 20% off your business profit before income tax. Both happen on your main return, and both lower your bill. Let's put it all together with a real example. Say you earned $40,000 driving this year, and you tracked 18,000 business miles. Your mileage deduction is $13,050. Add about $2,000 more for phone, tolls, and supplies, and your expenses total $15,000. $40,000 minus $15,000 leaves a net profit of $25,000. Now the taxes on that $25,000. Your self-employment tax is about $3,500. But watch what the mileage did. If you hadn't tracked those miles, your profit would have been around $38,000, and your self-employment tax alone would jump by roughly $1,800, plus more income tax on top. Tracking your miles saved you well over $3,000. Now the second mistake that wrecks drivers: not paying as you go. Because nothing is withheld, the IRS expects you to pay your taxes throughout the year in 4 installments, called quarterly estimated taxes. If you owe $1,000 or more for the year and you skip them, you can get hit with an underpayment penalty on top of the tax. Here are the 4 deadlines. For your 2026 income: April 15th, June 15th, September 15th, and then January 15th of the next year. Mark them now. Missing them is one of the most common and avoidable gig driver penalties. So what's the system that keeps you safe? 3 habits. 1. Open a separate bank account and move 25 to 30% of every payout into it for taxes. 2. Run a mileage tracking app in the background, automatically, all year. 3. Keep your receipts. Do those 3 things, and tax time goes from terrifying to a 10-minute task. Quick recap. You're a business, so you owe income tax plus 15.3% self-employment tax. You owe it whether or not you get a form. You report on Schedule C, where every deduction, especially mileage, cuts both taxes. And you pay quarterly, so you're never blindsided in April. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. Always educational, never advice for your specific situation. Bottom line, gig driving can absolutely be worth it, but only if you treat it like the business it is. Track every mile, deduct everything you're entitled to, set money aside, and pay quarterly. Do that, and you'll keep thousands of dollars that most drivers hand the IRS by accident. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.